Thank you, Lily and Philippe. Philippe, some of us in the room will remember the terrific lectures, in British English, perhaps I'd call them bollockings, that your dad used to give bond market participants at Euromoney conferences in years gone past. But that was a superb, efficient tour of the horizon. Whether we'll be able to do the same now on digital assets remains to be seen. It's a complicated and detailed area. Just to recap a little of what we heard already today, I think we heard very clearly a mixture of interest and caution on digital assets from JP Morgan, Rothschild, but also, of course, from the Huobi entrepreneur, billionaire. He sounded pretty prudent and cautious about some of the crypto assets and digital currencies that are available. But on the other hand, of course, there are opportunities. I can remember my cleaner about 6 years ago asked whether her husband should buy Bitcoin. And I gave her terrible advice in retrospect. I said, don't unless you can afford to lose the money. And what I should have said is leverage to the hilt and go as long as you can. If I'd given that advice to her 6 months ago, it would have been good advice. So we don't quite know where we are with that. I think Huobi said Bitcoin and Ethereum and that's about it in terms of what he thought was safe. JP Morgan and Rothschild said definitely appeared interested, but were concerned, I think, about market structure, and we'll explore both the asset side and the market structure side now on this panel. I've got an excellent panel with me to talk about it. We have Boris Bilovitsky as Chief Revenue Officer at Copper, which is a digital asset trading and securities services company. We have Stefan Edelmann, who's Executive Director, Asset Management at Sygnum Bank, which specializes in digital assets. And we have Tim Jones, Executive Director at Tata Limited. And Tim has a long history in digital cash and payments, including pioneering Mondex all those years ago, one of the first experiments in digital cash in the early 90s. OMFIS spends an awful lot of time in one corner of this market, which is central bank digital currencies. And I can tell you in those discussions that most central banks, even after talking about it for 2 years, for the most part, still don't know what to do. That would be the brief summary of the many hours we've spent on it. So let's kick off and review the opportunities and the investment horizon first. So I'm going to turn to you first, Stefan. Give me a quick tour of the horizon on digital asset investment opportunities and the available mechanisms to invest in them. Give us a quick tour, please.
Thank you, John, and thanks for having me on the panel. I think as an investor, to build your framework on how you could invest in digital assets, I think you need to understand one thing, and you have to answer 2 questions for yourself before investing. And I think the first thing to understand is that not every cryptocurrency wants to be a currency. What I mean by that is that actually the whole digital asset or the crypto asset space we don't see it as a asset class, but rather as an asset universe, because obviously you have the foundational blockchains, the protocol layer, as it's called, where that's actually the technology where a whole ecosystem is built on, and that the protocol layer we see as an actual new asset class with completely new risk and return drivers and completely new characteristics. But built on that, still within the digital asset space, I'm sure you've all heard of NFTs, that we think is closer to an art investment. You have the application layer where you have, for example, decentralized finance applications like exchanges or lending protocols that then, if you invest in the governance tokens, are more kind of like an equity investment. Then you have stable coins, you mentioned them, or CBDCs. You have tokenized assets that are kind of a fractionalized digital asset from a real world asset. You have securitized or security tokens that are an equity or a bond, but just issued on the blockchain. So you see there are many different parts or many different market segments that you can look at and invest in with completely different risk and return drivers. So there's not just I invest in a currency and I believe in it or not. So different use cases behind. And then very briefly, the two questions you have to ask yourself as an investor, I think, is one, how do I implement digital assets or crypto assets in your overall asset allocation? Is it kind of a separate allocation next to your equities, bonds, etc., where I would say the protocol layer as a new asset class could fit next to it? Do you put it in your alternatives bucket, or is it an add-on where you have more equity-like digital assets in your equity portfolio, in your bond portfolio, etc., etc.? And then lastly, the second question you have to answer yourself, kind of what is the outcome that I want to achieve? Is it participation, where I believe in the growth of the market? Do I want to have directional exposure? Do I want to have more a yield kind of strategy that is then less directional, where you should not be impacted by the volatility too much? Or same questions as traditional investing, active versus passive, directional, non-directional. So all in all, I think it's a very broad field where you can invest. I think if someone tells you I'm investing in crypto assets, I think then you should ask back, yeah, but where and how do you invest? It's not just one thing where you can invest.
A quick housekeeping. Can AV please bring me 3 working handheld mics? That would be appreciated. Thank you very much. Okay, good. Tim, very usefully for your worldview, I think we've had some interesting problems in areas of the crypto assets world, including gating yesterday by Celsius, and problems with things that ought to have been stable coins but weren't quite. Some people see that as a useful correction to a new market. Others saying it's like when securitization crashed. What's your view?
Okay, so is this microphone working? This microphone is working. Thank you very much. So look, the first thing to say is that I am extremely old. And because I'm extremely old, I've been around a bit. And I've been involved in digital cash seriously since about 1989. That is about 33 years. So this is a very complicated and jargon-infested world. But what was that? Answer the phone. Who was that? That was another microphone. Is this a party? Can everybody join in? They're all working now. So the first thing I would say to you all is be very, very careful. I'm a banker. I was 17 years at a boring old bank called NatWest. I ran the retail bank at the end of that period, so I've done a proper job, 33,000 staff, 2,500 branches, all that stuff. Now, we were a heavily regulated institution. I know a lot about regulation. I've also been on the main board of ITG, which was a broker-dealer in New York, bought by Virtue Financial a few years back. So regulation is there for a whole raft of reasons, and one of the major reasons is investor protection. And regulation tends to create a great deal of transparency and a lot of rules about what you're allowed to do, what you're allowed to say, and the penalties for saying the wrong thing, for example. This world is mostly unregulated. But there are bits of regulation around the edge, but it is mostly unregulated. And that means that a lot of the protections you take for granted may well not be there. So please don't pretend that they are. So when a CEO says something, don't think that there's been a lawyer to check that it's accurate, as there would be in a regulated institution, because it's not regulated. It's the first thing to say. Second thing to say is, if you define a cryptocurrency as an uncollateralized asset, now, you can go to sleep, for those of you that this is too financial, but if you do define it that way, there's nothing there. Absolutely nothing. It's an instrument based entirely on trust that somebody else is going to want to trade it. there isn't any collateral, none. So please bear in mind that an uncollateralized asset is uncollateralized. There's nothing there. And that this is a largely unregulated area. A lot of the institutions on the panel here, and many others, are trying to make a really good job, very ethically and intentionally, of creating layers of function, service, exchanges, and all the rest of it around this. But I will leave you with those two thoughts. What's unregulated is unregulated. What doesn't have collateral doesn't have it.
Thank you, Tim, for the devil's advocacy. I know there are people, including even within central banks, who think there is nothing there for fiat currencies either.
But that is one of the great lies.
Absolutely.
Lord Lamont, I don't know if Lord Lamont, I don't know, sorry, no, let's deal with this lie. Let's deal with this lie. Lord Lamont will talk to you about this, the exit from the exchange rate mechanism. Fiat currencies represent a forward look on the prospects for the economy. Politicians go to enormous lengths to maintain the value of their currency. The actual collateral strategy of the central bank for M0 is irrelevant for anybody that knows about the M numbers. It's such a tiny proportion of the total monetary wealth of the nation. But do not be fooled that there's any equivalence between the collateral strategy for a cryptocurrency, which there isn't, by the way, because there's nothing there, and fiat, because that's nonsense.
Thanks. Fair enough, Tim. I'm going to introduce our panelists. I think you were entangled in a logistical nightmare with Eurostar, so we've all been there. But Marjan Delatine, who's Managing Director at Payments at Settle, a DLT security services and payment solutions provider, will come to you in a moment to talk about market infrastructure. We're just still on the fundamentals, I think, with Tim. Boris, do you want to put the case for the defence? I realise you're there to facilitate the plumbing.
No, well, first of all, I'm horribly underdressed. I apologise, but I had surgery on Friday, and we're
overdressed.
Into a suit. It did look good. So, yeah. So, wow, there's a lot to unpack. We at Copper, we look at it from a pure infrastructural perspective to start off with. There is a lack of regulation. That is true. However, the problem is that the focus a lot of times is very much held on the cryptocurrencies itself, or whatever they are. Like, you can go into the distinction between stable coins and everything else, but ultimately the interesting part is the technology layer that underpins it all. Now, the reason why we started our business is in order to make sure that we are killing and basically take the trash out of the traditional financial services system that currently exists. Now, I know that maybe steps on a couple of toes here in this room, but ultimately, institutions such as NatWest and many others, RBS, and all the big banks, are seeing the opportunity to figure out a mess that has been built on top of core banking systems that have been built in the 70s on a programming language called COBOL, actually. And you are dealing with the necessity of T+2 settlement, T+3 settlement. If you trade fixed income, it's T+25, which is retarded, to put it mildly. So this is the layer that we're focused on. Now, as a derivative of this, of course, to start off with, you are dealing with things like Bitcoin, things like Solana, and so on and so on and so on. Now, that layer, this is very important to understand, where I am having the contrary view to you, Tim, is that they do provide a intrinsic value of making sure that that technological change is happening in a way that we can prosper going forward. And that's specifically on the pure blockchain-based technology layer. What I mean there is no more waiting for settlement. Where the regulators are coming to grips now, and they have always been behind, let's face it, and they are behind a lot. Their core purpose is in order to safeguard retail. That's what they have to do. Now, when it comes to that, when it comes to this position, what you need to know is that you're suddenly dealing with something that nobody has heard of and is moving at absolute light speed in terms of innovation. which is very important in order to make sure that we are able to unlock liquidity, unlock opportunity, optionality, where currently there is none. I'm not going to go full down the DeFi route of like, you're going to sit at some point on a Sunday morning in your home and you're going to draw a new mortgage in your underwear, and then you trade that mortgage against a tokenized insurance contract because your plane was late somewhere. Like, that is the very, very far future. But what we're talking about is simply making sure that the world of payments, for example, the world of settlement, because most people don't understand what actually happens if somebody punches in a trade on the 3rd floor and then 15 headless chickens run around 3 floors above for 3 days trying to settle that trade between Boney and State Street, which comes back to the point of it being extremely retarded. So this is where you need to have the focus, and there is a lot out there from a technology perspective that makes sure that you actually see what the value is of some of those technologies. And there is so much more I want to say, but it's very hard to pick.
We're going to come back to that. Marjan, I want to ask you a slightly different question. I suppose what Boris is saying is, regardless of the intrinsic value of some of these instruments, and Tim's put a robust case why there might be none, the infrastructure needs changing anyway for how for capital markets and money operates. So do you think that even if all the stable coins by one or two go bust and take some retail investors with them, and there's a huge hue and cry and a regulatory fuss, that the underlying technology is here to stay in terms of DLT settlement facilities?
Yes, well, I think it's very interesting. Probably I missed the initial part of Tim, but I do agree with Tim. There are lots of speculations today around blockchain. But I was last week in Money 2020. I don't know if you're familiar with that. It's a big event, especially around payments. So you have lots of fintechs and lots of hype around everything. It was very interesting because we had a good combination of representatives. And HSBC lady said, blockchain is unstoppable. So for a bank like HSBC, a testimony like that is very interesting. So I think if we step back from what was the promise of the blockchain decades ago, which was a rule-based, decentralized monetary policy, right? And the promise was that we give the freedom to the people so they can manage what they want. If we step back today, this is not the case. There is no real governance. There are some model of the governance. They call it decentralized authority, but it's still very nascent. And the power is still very much centralized. Well, the way I see that, and I'm coming from market infrastructure. I worked 10 years for Euroclear, 10 years for Swift, 4 years for Ripple, and I'm now in a very small company working in actually something that could bridge the gap between the world of the hype speculations that it is today with what is the regulated market, and how you can leverage actually some of the important feature of this technology that it's unstoppable, in my opinion. I would say the main advantage of the blockchain, and this is something that we don't have in any market infrastructure in the world, is that the value and asset is on the chain. You don't have this today. You have a system, double book entry keepings in banks, very costly, as you mentioned, mainframes, COBOL, that nobody even understands the language anymore. Exactly, it's highest, exactly. How you can move this from the state that it is today, which is only a messaging system in a 21st century. I don't know any other technology that can do that today. And I know all of the challenges with ESG, with speculations, but let's face it, asset managers, the investment is interested to go towards this world because hedging is much more easier today. Well, of course, with the interest rate change, this might shift because the power is now going back to the US dollar, and probably soon in Eurozone, they are following the same trend. But when you are in how do you say, negative interest rate, the money that it is printed, and the stock market that it is not behaving, so where you will put your money? And that's why. And many large organizations are putting crypto as a liability in balance sheet. So we cannot disregard this paradigm just because of the regulation. I think CBDC and the central bank, probably because of the FOMO, that probably Facebook will be the, let's say, the more fluid currency. They are looking at that, but the crypto today is an intangible asset. So they cannot become a currency after 10, 12 years. They could be a means of account, a unit of accounts, but they are not a value of the exchange or medium of exchange. So there are so many things behind it. So I think this is how do you say, a slow motion. Is not fast. And I think everybody should be aware of that. But in series of markets, especially with the inflation and how you can hedge counterparty risk, crypto is becoming one possibility. Today is not the best day to talk about the value of Bitcoin because it's, I don't know, 38% down. And I hope that you are confident enough to keep your portfolio and not sell it. But anyway, there are so many things. But I think the only way that we can bridge this gap is to tokenize the regulated liabilities.
Marjan, and we'll come back to that in just a minute, and indeed the market structures that you're talking about. I just want to switch back to assets for a moment. There's a lot of confusion about what money is, what securities are, what commodities are in this space. Stable coins have, as I've mentioned, proven not to be in some cases. Bitcoin behaves like a commodity and people refer to it as money. And I don't think it's money, you might. So let's first distinguish between all these different asset classes and work out which are money and which are assets. I want to spend a little bit of time on that before we go back to exploring CBDC settlement and market structure. And Tim, so you were an initial pioneer in digital money. How would you define money for the digital and crypto scene?
Okay, so let me be clear. I am an enormous fan of digital cash. I have devoted years and years of my life to designing and promoting digital cash solutions. I completely agree that T+1, let alone T+25, is Neanderthal, and we should be having instant settlement. One of the reasons I'm such a proponent of digital cash is that tokenized digital cash enables instant settlement out with the banking system. To answer the technical question, the world of money is split into M's, M0, M1, M2, M3. And M0 is notes and coin in circulation, physical notes and coin. You add sight deposits, money in banks that you can get your hands on straight away to go to M1. We don't need to go any further. For me, digital cash in a central bank issued way is just merely the addition of a third technology alongside notes and coin, digital coins within M0. That's what it is. It doesn't affect commercial bank money, which is sight deposits, which you add to M0 to get to M1. For the technicians in the room, there's a huge difference between M0 and sight deposits, which is that in M0, the claim is on the central bank directly, and in the rebalance, the claim is on the commercial bank, and that's a different class of claim. For those petrol heads in the audience, we can go there later. But the core thing is that if you had a tokenized digital coin in dollar, another one in euro, another one, et cetera, et cetera, et cetera, you could do instant FX online. You could instantly trade them through the very brilliant things that the people on the panel here are building, and everything would be great. We don't. What we have is a set of largely uncollateralized, largely unregulated crypto assets. Be very careful. Do you know what the collateral structure of Tether is? Nor do I. Are they required to tell you? No, they're not.
So would you say those are money or not?
Well, so this is where being very old and a big digital kid, this is where life gets very interesting. Digital things aren't the same as analog things. They are qualitatively different. So they have features that borrow from different definitional areas, and therefore you can't actually in Venn diagram sense one-on-one say, oh, look, that one's a currency, oh, that one's an asset. Now, a unique NFT, which might be an image that has been created and has been protected with crypto so that it can't be replicated, I think that's close to a work of art. So I'd say that's a unique kind of asset. A Bitcoin, which is one of the 21 million that will eventually exist, is a kind of Krugerrand. Because there's not that much gold around. It's a kind of digital gold thing. It's rubbish to transact. We know all the history of how difficult it is to transact Bitcoin, but it's not really a currency. It's not easily transactable, but and it's got no collateral. So what's it worth? But it's sort of not an NFT either, because there will be 21 million of them, and so. They are, I think the horrible answer is that each needs to be treated on its merits, and you have to try to understand what the thing is and build your own description of it.
Okay, thanks. We'll come back to NFTs in a minute. That is an interesting area also for this room. Stefan, could you attempt a definition of money in the digital era, and which of these coins are money or not?
Tough question, especially after Tim. I believe, I see it always kind of through an investor's lens, right? And I think the whole topic, and I know I'm not exactly answering your question, but I think the whole topic around currencies, stable coins, CBDCs, etc., that will be mainly driven and solved by the regulator, right? I mean, having seen what with the Terra, Luna, etc., happened, obviously huge problems and a setback. And I think after all, regulators will define what is actually money and what not. But I think that's, as an investor, that's just actually a very small part of what I can do. What I said before, that there are so many different other things that are crypto assets and not cryptocurrencies that are very interesting and as it was said, built on that technology that can help solve so many problems in so many areas of business that I think you actually should step forward after kind of this currency discussion, what is money, what not, because I think this will be solved not by us in this room, not by us in this panel, but from a regulator at one point, and I fully agree. I think right now we will see that some stable coins will survive because there you have a clear collateral, everyone knows what the collateral is, and everything else will have a very difficult life afterwards.
Let's push that a bit further. Would you then say that investors should wait for the regulator to decide what money is and then take an investment view on the rest as quasi-commodities?
I think it's much broader than also kind of it's money or commodity, because I think some crypto asset investments are equity-like, some are bond-like, some are art, what Tim just said. So I think it's really, you have to dig deep, you have to do your research, and also then formulate your investment view on where do I think this technology adds value, and then you should invest there.
Okay, so I think I'm hearing that money is something that the state produces, or at least heavily regulates. But and we're going to explore that a little bit more now before going back to NFTs. Some of the stable coins may end up, we think, from one of our CBDC discussions, potentially plugged into RTGS, at which point, and regulated by central banks, at which point stable coins actually are banks rather than currencies. So watch out for that as well.
And I think perhaps one point to add, what we hear in Switzerland from our national bank is that there will be rather a coexistence with clear rules, but they don't say that they want to ban every other currency or money out there. There will be a coexistence, but obviously with clear rules that are set, then investors and users of this money will know what is it all about.
Okay. I want to go back to market structure briefly and the role of the state. So do you think that DLT-based assets can evolve in isolation of the state and state versions of money, or do they need to co-evolve, including using wholesale CBDC for settlement, as they do in a Swiss experiment already, and so on? So tell me, perhaps starting with you, Boris, whether you think the state needs to come to the party on digital assets and help settle it with state money.
Yes. So yeah, the answer to this is yes. The initial view of those crypto anarchists 10 years ago of, screw the central banks and monetary and fiscal policy shouldn't exist and we should be in charge. That will not happen. Quite simply, it will not happen, and it also shouldn't happen. When we talk about everything that has been mentioned both by Tim and Stefan is pretty point correct. I mean, when it comes to the mean for settlement, but this is where we're back on the infrastructural side, right? Like, how am I going to run my business? If I'm a bank, if I'm a payment processor, if I'm Atlantis Marquardt or whoever else it is that is managing assets, that is moving assets, that is paying for goods, which is basically everybody here in the room. You would deal with an infrastructure that is far more sophisticated, and that's ultimately what it comes down to. So there will be the coexistence, because without that, there will be no transition. Let's put it that way. It will not just stop from a Wednesday to a Thursday, which is going to switch everything off that the government does and just go full decentralized. It's just not going to happen. The good thing is that for the last, since it was 4 of us sitting in a cool flat in Shoreditch with a great idea of figuring out of how we can rewire this financial services system, having worked in it for about 15 years. What you see now is finally those players coming into the field. For example, we just signed everything with State Street a couple of months ago. They are going to go full digital because they see, and this is where we need to step away from Bitcoin, Ethereum, Solana, and all this stuff. This is currently great fun, and if you know what you're doing, you're making a truckload of cash. Good stuff. But ultimately, it comes down to the fact of what does this mean for a bank when you tokenize assets that are sitting on your balance sheet and in a liquid format, and suddenly you have a different capital requirements regime. Now, this is where all the CEOs that have been opposed of this over the course of the last, 7 years, or loudly speaking out for the last 4 years, are making a 180-degree turn because they see, oh, hold on a second. If we're able to do this, number one, we save a truckload of money, and number two, we're able to kind of reform our core business to the extent that you're dealing with a much more competitive landscape and something that basically enables the world that we live in order to move better, faster, more efficient. So short answer to this is yes, it will coexist, and in many ways it will be, and it has to be governed by regulatory bodies in order to make sure that this is happening properly. To Tim's point, that it's collateralized properly.
Thanks, Marjan. Also, geez, a very interesting experiment in Stefan's country. The Swiss Central Bank it's called Helvetia or Jura or something like that, isn't it? Is settling traditionally and also on DLT at the same time. So they're actually having the systems coexist to see how it will work. And one point of that with wholesale CBDC is simply to eliminate some of the settlement risk that you have. We heard earlier from some of the wealth managers, they're worried about counterparty risk, settlement risk, and so forth, the mechanics of the market, let alone the fundamentals of the asset. How do you see that evolving with the help of the state, and is it necessary that state institutions help?
As you rightly mentioned, we are talking about only experimentation at this stage, right? So everybody's trying to see how it works, trying to somehow transpose what is the regulated or the way that the market is functioning into this. So it's still very much basic and I would say just experimental. I personally think if this world will survive, you need to institutionalize it. And when you talk about money, it's about power, right? And obviously, that's why I'm referring to CBDC, or the fact that if you want to move to this fully digital world, an on-chain world, we need the central banks to get involved. So all these Helvetica, or you have many of them in APAC, which is Enbridge or Dunbar. But well, these are experimentation among central banks to see how we can realign at the end the finality of settlement in a more efficient way. But where is the role of the banks or regulated institutions? Everybody was thinking that DLT will replace the regulated finance. It hasn't.
And
it
can't.
won't.
The central banks don't want it to.
And nobody, actually, I don't think that the market will move to that. And so the coexistence is there because there are many frictions. The on-chain ramp on and ramp up doesn't exist, it's very complicated. So that's why it cannot replace a currency. This word is a word that it is built in parallel, but it doesn't have all the elements to survive alone. So that means that you need the other part of the game. That's why I'm coming to the fact that this is not about only hype. I think it's about tokenized economy. And it is bringing lots of efficiencies beyond the politics. I think that that's very important. When we look at the CBDC, there are lots of course, hype around retail CBDC. I truly, personally, this is my opinion, I don't believe in a retail CBDC in a mature market like us.
And they don't either, actually.
They don't either. But it was a lot of conversation around that for a few years, right? So it's a wholesale at the end, wholesale cross-border. And this is where a lot of interest lies, right? Of course, we can make that efficient and cheap, but the wholesale will not be cheap. Price is not always about efficiency. Price is about power. So I personally think that we should look at real problems and try to solve that. We need central banks, we need partnership with the private sectors, and we need a mindset for the regulated markets to look at this differently. This is not rebuilding what we have today, it's rebuilding something new. And well, when you are rebuilding something, there are so many risks, so many frictions, so many power that could be lost. And decentralized is something that is risky. But I really feel that if I compare that to 5 years ago when you were talking about blockchain and you had only the innovation hubs of the banks were experimenting and saying, tick in the box, well, it's nice, why not? We wait another 10 years. I think this approach has changed and we see really large organization, wholesale, global banks that are looking at this beyond just the experimentation and innovation and going towards live pilots. And this is a start that needs to be somehow oversight by the central banks.
Well, and we know from our sessions, they don't seem to love the banks that they regulate, but they definitely need them. There are a huge risk to disrupting. The financial system is much more complicated than most people realize, which even central bankers keep discovering. But before we finish up on NFTs, very interesting scene, I'd like to offer the chance for the audience to ask questions of this panel so far. So we've got a couple of questions already. Mics, please. So you, sir, had your hand up first. Please say who you are and put your question to the panel.
Thank you. My name is Charlie Morris from BikeTree. And to Tim, someone's got to come back to your very, very good point you made earlier about there being nothing there. I think there are 20,000 tokens or so, and that is absolutely correct. In most cases, 99% or so, nothing is there. But there are room for a few with value. And Buffett recently said, I wouldn't do the accent, but I wouldn't buy all the Bitcoins in the world for $25. And if he did, they'd be worth zero because he'd have taken out the value. The value is the network. You described Bitcoin as a thing. In my pitch, I say it's not a thing. It's a part ownership of a network. And there's room for one winner in digital gold, as it were. Not that it's exactly digital world. And the other ones, the many, many copycats of Bitcoin have failed because only one can have demand. It's a natural network effect.
So keep believing, keep drinking that Kool-Aid. I think that, no, it's good for you. It's good for you. Keep you young. Look, one other thing I'm going to say, mildly controversial. Blockchain is largely baloney. Of course, there's a need for re-engineering, but nearly all the blockchains that are now proposed have permissions managers, which reintroduces a single point of central control. You can do a Merkle chain, for those of you who are a bit technical, if you want an inviolable record forever of every single transaction. Jack Ma does 250,000 transactions a second, right? On Singles Day with Alipay. That's scale. And that's instant settlement on a single liquidity pool sitting in a bank, but that's commercial bank money. So what you have to do here is work out what technologies are appropriate for each task you're seeking to undertake. Then understand who owns the assets represented on the databases of these technologies, and then work out your counterparty risk. The big missing actor here is the central banks. They've stood on their hands for 25 years. When I did Mondex, which we co-invented, Graham and I, in 1990, and took to the Bank of England in 1991 for a cup of tea. That's what we did back then. They knew all about a digital M0 in 1991. Okay? They've done nothing. So the real story here is that these lovely people are creating a series of digital capabilities that at the moment, I'm afraid, are built largely on the sand of assets underneath them that are a bit flaky, in my humble opinion. If we can bring the central banks and the major players in with properly regulated assets, then a lot of what is being built here will have its day in the sun. They'll then stop talking about blockchain because blockchain's irrelevant, but they'll still have built some really great technology.
Thanks, Tim. Another audience question, please, to the lady here. Monica, can you show me with your fingers how many minutes I've got? Okay.
I'll be brief. Thank you, Leslie Liu. So quick question, probably more about plumbing. I think some of the panelists are, crypto native, some are from the traditional finance industry. Obviously, we have a vast gap here that we're trying to cross. And going back to the point about stable coins, it seems like all of you agree that, if it's a fully backed fiat stable coin, it probably is useful, have great utility value, and it has been proven that has use case, whether it's in the West world or global South. The question is, once it's regulated, and it probably should be regulated, I presume that it will be issued mainly by charter banks or some sort of regulated institutions. Now, the question is, why is it that so far the banks globally have not sort of jumped on the bandwagon yet? Obviously, it's something of great utility value. It's backed by the state, by the government, but none of the banks have jumped on it. The hypothesis out there is that's going to really kill the, one of the positive line item on the income statement. I'm trying to understand from an infrastructure and plumbing standpoint.
Do you mean the commercial banks, why they haven't jumped on it?
Commercial banks, okay. Yes.
Yeah. Thank you. Some of them are trying to actually, they're trying to create their own stable coins. So they're thinking about it. But Stefan, why don't we turn to you on that first?
I mean, I can give you a very concrete example. We at Signum, we have created a digital Swiss franc, and not because we don't like the Swiss franc, and it's 100% backed with actual Swiss franc at the Swiss National Bank. But why we use this is for our tokenization team, when we tokenize assets like what we did with Picasso or equities, etc. Then you need to have something for the settlement on chain, right? So we need a digital equivalent of the Swiss franc that we built, asset 100% collateralized with the Swiss National Bank. Just for technical reasons, we would love to have an official digital Swiss franc, but it doesn't exist. And why it doesn't exist, I can't tell you. I think it's a lot about infrastructure, and I'm not the specialist, but I think it's perhaps infrastructure and also the willingness of why should I change, because change is always a bit frightening. And if you're a national bank, I think you're very much risk averse. So I think it will be needed. We need digital currencies to empower the whole tokenized world that you mentioned for many different use cases. And it's not about replacing current money for a bit more esoteric reasons. Everything is decentralized, what has been said. We need equivalents that we can use on chain. Otherwise, the whole on-chain economy doesn't work. And that's why we created this digital Swiss franc, not out of pleasure or because we think it's better, but we need it for other projects on chain.
I got the impression that central banks and commercial banks relaxed a lot when the US regulator sat on DM, but we'll come back to that. Come back to that another time. I'd like to finish up on NFTs, because I think that does sound genuinely useful to try and create fungible assets, tradable assets out of illiquid items with value in them, and so on. Sounds interesting and useful. Do we see? Is this a fad-like securitization was, or is it a genuine change that is bringing new opportunities for wealth managers and investors? Starting with you, Boris.
Yes. No, I'm coming back to your point just real quick. Wrapping your head around a mint burn operation is a difficult one for a bank to figure out on many levels. But I can assure you and I'm gagging to tell you all the names, is they are figuring it out as we speak. Because they know they're able to basically issue those currencies themselves because they already have the regulatory framework for it. NFTs. So yeah, ultimately same topic as what I said before. The tokenization bit is crucial, and NFTs should be heavily loved by Tim because it is collateralized. So on that front, it is a way. You're not shaking your head on that one, are you? Oh, we need a coffee.
That sounds like fair cop, Tim.
Okay, no coffee, champagne. So what I'm trying to say here is it is a incredibly welcomed addition in terms of innovation of what's coming out of the space. The main problem that we have sitting on this panel and just generally in the economy is that you're dealing with a camp that is incredibly tech-enabled. Those are technologists, people in white t-shirts, tattoos, and mustaches that are sitting there with their headphones on and don't speak to anybody, who are making sure that innovations like this are happening. On the other side, you have a room like this, and Tim, where you need to try to figure out of how to satisfy the core needs of how do those two worlds bridge and gap. Now, an NFT is a very nice and straightforward way, if collateralized, and it is collateralized, in order to allow fractional ownership, in order to allow even on the settlement layer, that already works. So a lot of experimenting that is currently happening on that front. Again, and that's why I agree with Tim, it's very early. But there are certain things that you can already invest in on the fractional ownership side, which is very interesting, and which is also why Signum and others have been doing that great work on the tokenization side. So a space to watch, and it is an easier way of, not necessarily having to buy a whole Picasso and maybe just half a Picasso, which would be interesting for Atlantis, Marquardt, and others out there in order to add it to a portfolio. So,
yep, sounds interesting, doesn't it? I know we're out of time. Do come and find my panelists to chat at the coffee break. This is an important, interesting area, and they're all at the forefront of it. So definitely worth talking to them. But I want Tim to see, since you gave such a interesting rebuttal of the whole scene earlier, whether you agree that NFTs represent a new dawn of creating liquidity out of illiquidity.
Possibly play with them. There's nothing wrong with innovation. Play with NFTs. Why not? See whether it works. But to your question about why not central banks, currency, notes and coins, one of the most powerful products in the whole world, lasted for 3,500 years in their various forms, all the way from shells, right? They're owned by central banks. Central banks are public sector employees that have never launched a product in their lives. That's why nothing's happening here. They're sat on one of the greatest products of all time. They can't see beyond the end of their nose, but they have to do new product development here to take their product into a third technical form, a digital form. If you go and talk to a central banker about new product development, they blank you. They don't know what it is. The Bank of England Digital Currencies team formed in 2014. I asked them in 2020 how much consumer market research they had done. None. None.
They don't want consumers, Tim. That would be a terrible thing.
And it's not just them. You go and talk to the Fed and the others as well, right? So the conundrum here is that central banks own a product they don't know how to manage their way forward from, and they need help. It's okay in private rooms for me to be rude about them. We need to help central banks get there so that they feel confident enough to do CBDCs, and then we'll have proper central bank, national backed asset classes, which we can then start trading with instant.
I have to wade to the People's Bank of China's defense. There are 300 million people using the digital one.
Yeah.
So actually,
and watch for the Bank of Boston. The Bank of Boston design may be the one that brings the Fed through. And then if that happens, then everybody else will follow.
Exactly. So with that, we'll wrap up. Thank you to my excellent panel.